How's it going, everybody? Thank you all for joining me once again. Um, First of all, thank you everybody for the massive support on the first video. Well, I released 2 videos technically. One of them I was not planning on releasing, but I just decided to because I sent it to a bunch of private individuals when I was having people backtest it for me. And so that was a video that I used, but I explained it a little bit differently in terms of how they might understand it a little bit better, and it had some information that I didn't include in the newer video that I recorded. So I decided to just post it just because I knew that it would help other people interpret it in a little bit of a different manner. If you have not seen that video, please go watch it. It goes over a lot of the same tickers and everything like that, but it just talks about it a little bit differently in a different sense. In the terms of smart money concepts, ICT, market maker models, things of that sort. But this actually leads me into the first topic of conversation. Now, what we are going to be doing in this video is we are going to be discussing. I've listened to everybody's feedback. I've heard everybody's questions. I know exactly where most people are confused. It's very clear, so I'd like to address as much as I possibly can. I know that there are still going to be possible questions that maybe I fully don't answer. If I don't answer it fully, please let me know. Let me know if there's anything that you're still confused with after this video. I guarantee you there's probably still going to be things, so we'll just see what they are. But please just watch through this whole video. If you are skipping around, there are timestamps in the description, but I'd warn you, when you skip around, you miss out on a lot of very important information, and that includes on the 2-hour video. I know it's 2 hours, but I mean, if you could sit through school, if you could sit through a class, if you could sit through a lecture, if you could read a book, if you could watch Mr. Beast's YouTube videos, which are 45 minutes long, then you could sit through my video, right? And you could pay attention. So if you're not going to do that, you're going to get 50%, period. If you're going to skip around, you're going to get half of what I say. So I just want to make that warning. But with that being said, I would like to address some initial points, and then I will go through some questions that have been given to me on Twitter. And then I will be doing a top-down analysis. I don't know how long this video is going to be. It could be 1 hour. It could be another 2-hour video. Who knows? I'd like to make it quick because it's late at night, and if it's a long video, then I'm going to be getting to sleep late tonight. So let's just begin. So first of all, the Feigenbaum projections are not a strategy alone. I see lots of people that are trying to trade with it by themselves. They're just trying to measure a consolidation and just trade off the ranges. And if you do that, you will fail, period. It is not a strategy alone. You do not use the Feigenbaum projections as a strategy alone. It is a tool to support a predefined trade idea. I want to put emphasis on the word predefined. That means you define it before you use the Feigenbaum projections. All right? You already have to have a trade idea in place before you even make the measurement. The measurement is a tool. It is a tool to support that trade idea. If you just make a measurement and you just target the ranges, you are going to fail, period. Now, it is a tool that is best used with smart money concepts. Now, if you don't know smart money concepts, if you trade moving averages, if you're a breakout trader, if you trade the strat, And I have nothing against those people. I know so many people who trade so many different strategies, and they're very profitable, but they've been doing so for years. I know firms that have entire algorithms based on normal retail technical analysis strategies. I am not like other SMC traders. Lots of SMC traders seem to have a very big ego and think that they are the shit. I do not. If you make money trading, if flipping a fucking coin, I am proud for you. So, but with that being said, the framework that Smart Money Concepts provides is a very logical, it's a very step-by-step, it's a very mechanical framework for reading price action, as close as you can get to what might be going on beneath the surface, in the actual algorithmic sense. Now, I'm not going to say that I know the algorithm and shit like that. I see so many scam artists just act like they know the algorithm, they know this. First of all, what algorithm are we even talking about? There are millions of algorithms that are all in the stock market every single day. So to say you know the algorithm is nonsense. I could make an entire fucking video about this rant alone, so I'm not even going to go down that subject. But market maker models, smart money concepts, that is the best way to utilize this strategy. If you have ever looked into the Inner Circle Trader, or ICT, or Michael Huddleston, highly recommend you do so. He has 15 different fucking series that he's been filming since fucking the early 2000s. So I have a Google Drive. If you go to my Twitter, you can find it all there. Just go to the highlights tab, and it's all my important posts are in the highlights tab. I have a full Google Drive of everything there. But Michael Huddleston, or ICT, he provides a very logical framework. He's created what he calls market maker models. And then he utilizes a concept called the power of three, which less people know as Dow theory, and is basically accumulation, manipulation, and distribution. It is that cycle, that sequence, that is occurring within every single candlestick, within every single discrete moment of time. So that's basically what he uses, is a method of accumulation, manipulation, and distribution. Market maker models are power of three paired with two redistribution levels. So when the power of three happens, you get the accumulation, then you get the manipulation, then the distribution. Then there's two sets of redistributions. There's redistribution 1 and redistribution 2. That entire thing would be the market maker model, right? Whereas power of three would just be the accumulation, manipulation, and distribution, right? So they both go hand in hand. They're both paired together. They're one full entity, if that makes sense. And that's exactly what we are utilizing, right? With Feigenbaum projections, we are basically projecting the redistribution levels of a market maker model. And we are utilizing power of three as our confirmation, right? So if that makes better sense to you, right? We are using, whenever a power of three occurs, usually you'll see what they call a Judas swing, or what we call a perturbation. And you use both sides of the perturbation to match up with your initial condition with the first targets. And if they match up, then you know that your measurement is correct, right? So that's how we use it. Now, I'm going to switch over to the web really quick. Hold on, give me 1 second. All right, I'm going to switch over to the web. First of all, I just hit 20,000 followers on Twitter. Thank you, everybody. That's fucking insane. I didn't think I'd hit 20,000. My next goal, 50,000. 50,000. You gotta shoot for the stars. If you set low goals, you won't hit them. Or you'll hit them too easily, I should say. And it won't push you further. So I set high goals, 50,000. That's the next goal. Thank you, everybody, for the massive support. This is actually pretty insane. Now, I recently made a post discussing perturbations. Why call it a perturbation rather than manipulation? Well, the word manipulation, it tells you nothing about the actual dynamical aspects of the system. Right? Manipulation, it just tells you that somebody is manipulating the system. It says that they are basically acting in a way that is what's the word? I'm blanking on the word right now. In a not good manner. I'm just gonna say that because I'm trying to think of a word, but I can't pin down the word. If you know the word, I know you're probably screaming it at me right now. But they are not being good. They don't have good intentions, right? If they are manipulating something, right? They're trying to get around something, right? They are changing the system, but that doesn't tell you anything about what it is that they're actually doing to the system, right? And that's where perturbation falls in. Now, I'll basically rehash what I said in this thread, but I highly recommend reading the thread. But basically, if you have a ball, imagine a ball, just like a basketball, and it's sitting on the top of a mountain. Now, at the top of this mountain, it has a peak, right? If I set a ball at the very top of that peak, even the smallest bit of wind hitting that ball can make it roll in any direction, right? It could go left, it could go right, it could go forward, it could go backward, right? It's at the very tip of the peak, right? Now, imagine that it is at its balance point. It is perfectly balanced on the peak. Perfectly balanced. This, in nonlinear dynamics, we call a stable attraction point, right? It is at equilibrium. It is at its stable attraction point. Now, if I wanted to make the ball roll down the hill, one could say, yeah, you can manipulate the ball, or you can manipulate the hill. But what does that actually say that you're doing to it? It just says that you're doing something to it, but it doesn't tell you what you're doing to it, right? Now, what if I say I'm going to perturb the ball? Well, now you're saying you're kind of going to, you're going to like disrupt the ball. Right? Now you're saying a little bit more than manipulate. You're going to say that you're actually going to affect its presence in its space. Right? You're going to do something to it to affect its system. Right? You're going to perturb it. If I were to just take my finger and flick the ball, right? I would be making some type of perturbation into the ball, right? I would be hitting the ball with my finger, and my finger would be perturbing the ball in some manner. Or I could even perturb the hill. Let's say I was to take my hand and I were to karate chop right under its stable attraction point out. Right? It's sitting at that peak. I was just slice right under the peak. Right? Now I've perturbed the hill. I've disrupted the hill. I've done something to the hill to affect the system. And now that point, that stable attraction point, it is no longer a stable attraction point. Now gravity has affected the ball. You have energy. You have momentum, right? Building up as the ball rolls. So now that stable attraction point, it becomes what's called Well, there's a few different. People call it a deflector. You call it really whatever you want, but it's think of it like the opposite of a magnet, right? It can no longer go back to its stable attraction point once the system becomes perturbed. Does that make sense? So the ball, the issue is that price being equivalent to the ball, and price doesn't have gravity, right? Markets don't contain hills or anything of that sort. But perturb, it tells you a lot. Now consider that the ocean is kind of similar to like the state space of the market, right? Flat body of water. Now, if I were to drop a 100-ton boulder, 100 tons, that's a big boulder. That's basically a mountain, right? If I were to drop that into the ocean, what would happen? You would get a really big splash, You would get the displacement of water from the perturbation of that boulder into the ocean, right? The boulder perturbed the ocean. It disrupted it. It affected and changed the system in some manner. And you get the displacement of water, and what follows the displacement of water is a set of waves. These waves you call solitary waves, or in mathematics, you call them solitons. Solitary meaning they are alone, right? It's not like a frequency where it's a repetitive, continuous wave, right? It doesn't keep happening over and over and over again at some equivalent ratio, right? There was one wave, then after 3 seconds, for example, this is not realistic at all, but just to put in perspective, there's one wave, then after 3 seconds, there's another wave, then after 5 seconds, there's another wave, and after 9 seconds, there's another wave, right? But each wave gets bigger and bigger and bigger over time, right? That's how the wave happens, you know? So it is like you could think of price in that manner. Now, the boulder dropping into that flat body of water has a ton of mass. Price, of course, doesn't have mass, but what it does have is liquidity, which you could think of as kind of, or orders, which you could kind of think of as like fuel, right? Now, the more fuel it has, the more it can expand, right? If it has a ton of fuel, then it can expand for a massive, massive amount of time, which is what forms higher time frames. So you could think of the perturbation as I show in this image. You could think of it, this is what we're looking for, right? It's a consolidation, then it's manipulation, and then it's expansion, right? It's this pattern right here. Does that make sense? So when you think of it, think of a boulder dropping or a ton of liquidity hitting that flat body of water, which is a consolidation. And after comes the displacement of the water. And this flat body of water, or the state space of time of the so there's a space time, right? But we don't have space, we have price time, right? So you could say the state space of the price time continuum, right? But there is lots of giant input of mass, aka liquidity or orders, which creates a displacement of price and some waves in the time price continuum form, right? meaning waves in price and waves in time, right? So you have price wave, which is Feigenbaum price projections, which I showed you in the last video. But then you also have the time wave. I haven't gone over this yet. I gave a sneak peek in the video, the second video that I posted that I didn't announce that I was posting, at the very, very end. But I actually haven't gone over this yet. But yes, there is a time model. There is a time framework. It expands by the same exact ratios. Feigenbaum alpha, Feigenbaum delta. Exactly the same. So what you have here are waves, basically, that act as kind of like a waypoints for price, or trajectories that price will take, right? From that displacement of the input of mass, aka liquidity or orders, which is momentum ignition, as explained in the prior video. Momentum ignition is a strategy performed by high frequency traders, and it is to fake out breakout traders, make them think price is going into a false direction and get them a shit ton of liquidity. That's basically what they do. And to do that, they have to take price this way. A bunch of breakout traders will then go bearish. So then selling their positions, high frequency traders can then buy them at a very cheap price, but they then take them up. That is called momentum ignition. And the ICT teaches this as the order block, right? And it is a part of the power of three, which is a part of the market maker model. You see how everything is connected here. So understand that what I have provided is not a strategy in of itself. It is a tool outlining prior strategies that have been taught. It is a tool to support a predefined trade idea that is used as targets for that trade idea. Does that make sense? I am not a mentor. I am not a guru. I don't have a mentorship. I don't have a Discord. I don't post my positions on social media. I don't flex my accounts. I don't do any of that. I am simply a researcher. If you want to learn these concepts, then you should go to somebody who can teach you that. The only person that I am going to recommend here today is ICT, the Inner Circle Trader. Though on my Twitter, you could find, I've given tons of shout outs to other people that I love. I love their work on Twitter. If you want to find all those other people, just go to my Twitter. But in this video, I will only endorse just ICT. I will keep it very simple for you. Just go to ICT, start with that, and explore the rest of the internet afterwards. Now, we will be going to part 2 of this video. We are already 23 minutes in, so my guess is this isn't going to be an hour-long video. It's going to be more than that. But part 2 of this video is going over the questions that people have been asking. Now, I'm going to be mainly answering the questions of one single thread. Now, I want to make it very clear, I do not consider this person a hater. I am not calling out this person. I'm not upset this person in any way. I think all these criticisms are great. The reason why I'm using his thread is because I feel like his views summarize the collection of a lot of the criticisms I've heard from a ton of other people, right? So this thread that he wrote to me, it kind of summarizes all of that into one thing. So I'm just going to use his thread as an example. But again, if you are this person, I am not calling you out or anything like that. If anything, go follow this guy. but I'm just going to use your thread as an example for this. And I'll answer questions based off of that. So it would be this one right here, Seno Capital. I made a post talking about my 1 year anniversary of basically studying this subject. But Seno Capital made a criticism for me, and he gave me a few pictures. So I would just kind of like to go over some of his points, hope to address some of the issues. And then there's a couple, maybe a couple other things that I could talk about that he didn't address, but let's just start with him. So first of all, he doesn't think I'm a scammer. I mean, the first thing that I could address with that is I can't be a scammer because I don't sell anything. So I'm there's nothing I can scam you of. I'm simply just disclosing my research, and you guys could do whatever you want with it. But I'm going to do what I do with it, and what you guys do with it is none of my concern. I think your model is very incomplete. The areas you use are far too wide to be meaningful. I could use standard deviations and get the same or better success rates. Also, you have not taken time into account at all. So I'll just stop it right there and address some of those points immediately. Yes, this is incomplete. There's lots of things that I'm still working on, of course. And I've been open about those things, such as the time model. There's a reason I haven't fully disclosed it. Yes, I do have it generally figured out. No, I don't have specifics figured out. I can't give you the answers that I want to give you. And I'm not going to post something that I can't give you the answers that I want to give you. I could, if I wanted to, I could flex this all day and act like I have the answers. But the fact of the matter is there are some things that I'm still trying to work out. But if I were to put in percentage, I roughly have 80 to 85% of the time model, time framework, I should say, figured out. So, but yes, all this is, of course, incomplete. And for all I know, there are things I haven't discovered yet, and I might be working on this for another decade, which is 10 plus years. So I don't think that there's ever a point where this does become complete. I'm going to just continue building it, period. The areas that I use are far too wide to be meaningful. I definitely agree with that, especially in terms of the time model, right? If we go back to this image right here, that is a very, when we get to that third area right there, I don't even like using that on my chart. I think that third area is very pointless because it's just so big. Now, in terms of price, for price, that all depends on the consolidation. And you see, that is the point of the price model. If you have a giant consolidation, then chances are you're looking at a higher time frame measurement, right? With the price projections, the one where it really gets outrageous is the 14.786, I forget what it is, 14.7 something to the 18 point something, right? That's the one where it's like just ridiculous because it's such a wide range. But everything below that, generally you should be able to use. You should generally be able to use everything below the 14 projection level. If you ever have to use something above that, I guarantee you there's another projection that you could use that will give you closer targets or something on a higher time frame. Very rarely do I ever have to go to the 14 projection level. I mainly, if I ever showcase that, I mainly just showcase that to show you how many trajectories that it could actually get to. But in terms of actually using that in a tradable manner, I mean, like, this is ridiculous. You see this, how big this range is? This is from 1983 to 1985. If I told you that the top would be between 1983 to 1985, fucking, yeah, no shit, right? That's a 2-year, you're right, it's pointless. It's pointless. So I totally agree with that, especially in terms of the price or time projections. But for the price projections, I only agree with that for the 14 level. In terms of the 7 level, right, the 3 point or the 2.5699 and 3 point, etc., right, all the other ones, those are definitely still usable. And if you're having to go higher than that, it's because you're not using the most recent projection. So going back to this, I can use standard deviations and get the same or better success rates. Now, there's something about standard deviations that you don't get with Feigenbaum projections. Feigenbaum projections, lots of people ask, why can't I just make it 4.5? Why do I have to put 4.6692? The reason is power law. That little difference, making it 4.5 versus 4.6692, it doesn't make a difference for the first one. When you multiply it by 2 and 3, suddenly that small difference can be the difference of an entire year if you're measuring on a very high time frame, right? Or it can be a 1,000 pip difference if you're measuring on a higher time frame, right? So that very small difference might seem like a very small difference, especially for the first projection. If you're just using it for the first target, there's no point, right? Yeah, you can use 4.5 versus 4.6692. If you are trying to apply power law, there is a difference, and you have to take that into account. And that is what the standard deviations, normal standard deviations, do not take into account. They don't take into account power law. They are great for projecting the first target. In terms of projecting multiple trajectories ahead, you cannot do that with standard deviations. If you try doing that, it's just going to look like a shit ton of lines on your screen, right? But with these, you actually have defined ranges that are expanding at a defined constant. That is unlike standard deviations. Standard deviations, they go in increments, right? They're incremental. They're not expanding, they're incremental. And that is not helpful for power law. That's helpful for single target trajectories. That's not helpful for multi-target trajectories. So that is the big difference with standard deviations that you are missing. Standard deviations do work. I do not. For example, Dexter. Dexter is the king of standard deviations. I have him backtesting this theory right now, and he's loving it. Well, I think he's loving it. I mean, he speaks a different language, so there's a little bit of a language barrier that we're trying to get over. But he seems to be enjoying it. He's just trying to figure it out still a little bit more. But Dexter, I fucking love his shit, right? And he uses standard deviations. I don't need him to use Feigenbaum projections. I just want to know how it fits in line with how he perceives the markets, and if there's any criticisms that he might have. But if you use standard deviations, fuck yeah, if you're profitable doing it, do that. If you specifically are trying to figure out how to not just project one target ahead, but multiple targets ahead, then that is where you take the jump from standard deviations to Feigenbaum projections, right? That's the main difference. All right. Now, let's go back over here. Well, let me grab some water really quick. Okay. let's continue. Also, you are form-fitting your projections. Example, from your second video, why did you not include the candle here? It falls fully within the range. Could it be because then it wouldn't have reached the projection to the downside? Alright, let's talk about this. Let's look at the images that he provided. What he is talking about, I explained that your range is defined by the wicks, but your measurement is defined by the bodies. So your range, my range was defined by this rated and this rated, which would be this wick and this wick. And I said that you are to measure if the candle falls within those two wicks, then you are to include that in your measurement. In this video, I only made my box around these candles. However, he points out that these two candles actually do fall in line with that measurement. He's completely correct. Actually, I saw this before. You don't have to believe me, by the way, but I saw this before I made the video. The reason I made it with that is because when I'm trying to introduce the concept, I don't want to include all these nuances and little things that might confuse people. I just want to get across the straightforward concept first. But he's completely correct, and I probably should have been more straightforward with that initially. In the second picture, he shows right here, he makes the measurement. He gets the wick right there. But I don't know what he meant by it doesn't work to the downside. So let me see. Let's go to live. Hold on a second. There we go. Oh, shoot, hold on. I messed up. There you go. All right, so let's look at this now. And what he's talking about is right over here. So I explained that this right here was my initial condition, and I just highlighted that. Maybe I just even highlighted that or something like that. What did I do? Hold on. Let me look at it again. Make sure I'm doing this fully correct. Or is this on NQ? That's why. I'm on ES right now, and I did on NQ in that video. NQ. So I believe I just highlighted those right there. So when you do that, you see that the wick right there. Now when I expand it to that down one right there, it does still hit. So I don't know what exactly he meant by it doesn't hit your target to the downside. It does still work. As you can see right there, all the way over, all the way over. So right there, I'll do this just to help you a little bit better. So you see how that's on that line right there? Right, so it actually does still hit, technically. It actually fits a little bit better right here. Right here, a little bit better. But the issue that I wanted to avoid was a lot of, mainly, what I was trying to get across was the first two measurements. When you're making a measurement and you are using that side of the perturbation and that side of the perturbation to confirm your measurement. I was saying that the first two measurements, they normally should be perfect, meaning that they should very well respect that range. There shouldn't be any deviation whatsoever. That just wasn't a good example of that. So I was trying to make it easier for you guys to understand, but as you can see, it still fully works. I don't know exactly what he meant by it doesn't work anymore. The rule still stands. If you have a defined range, and if any candles close within that defined range, then you measure the bodies of that entire range. I would like it to be more perfect than this. I would usually like to see it something like this, where it fills the whole range. See how it fills the whole range right there, and it fills the whole range right there. That was the initial point that I was trying to get across to you guys, is that that's how you confirm your measurement is true, is by seeing it align with both sides. So it was a little bit harder to do that when you just have a wick that's barely hitting it like that. Does that make sense? So he does have a point, though. Maybe I should have just pointed that out initially instead of just putting it on a little bit different of a measurement. So my apologies for that. Now, let's switch back. Hopefully that addressed that point. So could it be because then it wouldn't have reached a projection to the downside? It fully reached a projection to the downside. So as you can see with my thing, if I just use standard projection deviations, it works quite well. Yes, again, if you are trying to just use one single target, it'll work, right? But when you have 50 different lines upwards, how do you, you might as well flip a coin, right? It could go to any one of those lines. When you have just 3 specific ranges upwards, now you have defined trajectories, and that's where Feigenbaum projections come into play. That's the difference between standard deviations. It's great for projecting one trajectory. It's not good for projecting multiple. Does that make sense? So I explain that here. So I just want to point out that a lot of what I've disclosed so far in my last 2 videos, this is only like 15% of what I've actually been working on. The issue is that a lot of the concepts I work with are way too complex for Twitter to even understand. Chaos theory is hard enough. If I start trying to explain to you attractor reconstruction theory and things of this sort with machine learning, it is going to be people are going to be unfollowing me at that point. So there are things that I am working on that are proprietary for a risk management system. There are other things that I'm working on that are public, that I am specifically making public, such as these projections. So there are a lot of parts of this theory that I am still working on. There are a lot of parts of this theory that I just haven't disclosed. And there may be a lot of parts of this theory that also need solving. I am still getting that data. That might need fixing, I should say. I am still getting that data. From what I understand, everything is working very smoothly thus far. So each one of these questions I've gotten a ton of. So I felt his thread was a very good representation of how some people felt. So I hope that covered a few of those issues. Now, over here, I explained that I was filming a second part, which is what I'm filming now, which is what you're watching now. And there were a few questions that came up through all these, so I'll just outline them a bit in the live. The main question that everybody is asking, everybody is asking, there's 2. 1. How do you know the initial condition is correct? I put extreme emphasis on this in my last video, and I will do so again in this video. So many people have been tagging me in posts and examples, but it's not correct because they're not doing what I'm about to explain to you right now. Again, I explained this in my last video twice, my 2 videos. I will explain this a 3rd time. How do you know the initial condition is correct? You only, if this is my initial condition right here. When do I make this measurement? When do you think I define this as the initial condition? That if I were to take the replay tool and I were to put it right here, we're going to go candle by candle here. Would I define this as the initial condition right now? The answer is no. No. How do I know that this is initial condition? I see a consolidation. I don't know what's happening. It could be anything. This is not, I don't know this is an initial condition. I don't know that. I'll delete that box, that way I could not affect any bias, but I don't know that that's an initial condition that I'm seeing right now. Let's fast forward. Okay, what about now? Now, price is turning, right? Now, is this an initial condition, Tristan? How do you know if this is an initial condition or not? You don't. You don't. You don't know. Now, what I can do is I could say, okay, what I see right now is I see there's a little ray right there. There was a little ray right there. Basically, this is like a little box. And maybe I might highlight this. I might have an idea. Hey, look, this looks like a consolidation. And maybe, let's say this is on the daily. You know what? I'm not even going to say that. I'm not, because we're on the monthly right now. So if you're looking at this on the monthly, and this is all that you have, the only thing that I could do is I could say that aligns with one side, but I don't know if just because it aligns with one side does not mean that it's going to align with all the others. I can make a good guess that yes, this could be an initial condition. Do I know that this is an initial condition? If I was looking at this in real time, would I legitimately trade off of the bet of this being an initial condition? And the answer is no, I would not. Now let's keep watching. Let's keep watching. Okay, what about right now? What about right now? Well, Tristan, you said that the initial condition itself could act like a trajectory, right? So it went from there. It went from there. What if this is a real initial condition? Again, my answer is exactly the same as before. This time, I can make an even more educated guess that yes, this might be an initial condition. Can I say for certain? No. I can. It went to 2 out of how many different targets do we have? 2 out of 8, 12? So I can't say for certain. I could say with high probability, I could say, yeah, maybe. Would I take a trade off of this being an initial condition in real time? No, I would not. I would not. Let's keep watching. Boom. Now what do we have? This is what we were looking for. Right here. I can now say with very high probability, almost certainty, that this is an initial condition. Why can I say that? What we are looking for, and I made this very clear in my first video, please go back and watch this if you don't remember it. But what we are looking for is a consolidation we are looking for manipulation and then distribution. This is called the power of 3. The power of 3. I only know that my initial condition is correct when both sides, the manipulation and the ending distribution, align with the projections. If one side aligns, let's do the exact same thing. If this is my initial condition right here, this box, if just that side aligns, I do not know that this is an initial condition. If it goes to right here, honestly, I still might not know. Do you know why? Because what if it keeps going? What if it goes then to up here? Or what if it even just goes into the middle, right? I don't know if that's even correct yet. I only know that this is correct when you see some type of response from that zone. When you see some type of response off of both targets for the power of 3. Now, this response could be something like this. Right? It could literally be like this. Or it could be like this. This response can vary because it depends on the fractal nature of the market. A trajectory on a lower time frame formed right there. Right? We don't know what time frame it formed on. It could have formed on the 1 minute. It could have formed on the 1 day. We're on the monthly right now. We don't know. But some trajectory formed right in there. And that's what created that target right there. As long as we get a response off of this end and that end of the power of 3 model, we know our trajectory is correct. So now you might be asking, well, okay, what if it did go past, Tristan? What if this one went past to 3.6692, but then you got a response? You got a response in the 3.6692 area, right? You got a response in your second target level. It went past the first one, went to the second one, but you still got a response. I would still define this as an initial condition. it just hit the power law, right? Usually, you will see that occur when there's SMT divergence, and you know that this ticker is stronger than the other one you're comparing it to, in which case this one will go further than the other one. Does that make sense? So, as long as there's a response in our target range on both sides, then our initial condition is correct. If there's only one side, we don't know. We could guess with high probability, but we don't know. We are basing this off of the power of 3 or Dow theory. In Dow theory and power of 3, they describe the same thing: accumulation, a manipulation component, and then distribution, right? Now, what if this expanded to right here? And then we got a pullback. Jeez, that's terrible. And then we got a pullback. Something like this. If I saw this happen in real time, if I saw it expand past the target that I was expecting it to, but not go to the next one above, I would not count it out fully, but I would not trade it at the same time. I would then not trust this. I would not be able to trust this. However, I would continue to watch to see if it then goes down up to here, to our third target. If we get a response there, then I might consider this deviation due to the butterfly effect. Does that make sense? But I would not trust it enough to trade it. The only time I would trust it to trade it is if it fell in line, both sides fell in line with our target range. I would then trade towards the second target. Right? So, if I see this, the only time I am trading this model is right here. On the pullback to the second target. Right there. I am not trading it down there. I'm not even trading it up there. I'm trading it like that. And this is exactly what ICT teaches as his 2022 mentorship model. Now, I guarantee you there are probably a lot of dots being connected right now. I could feel the excitement through the fucking screen if you are familiar with ICT concepts. If you are not, please watch it. The symmetry that the market shows will blow your mind. It truly will. Okay. So hopefully that clears up the question of how do I know that my initial condition is correct? And hopefully that also clears up how do I know how to find the initial condition. The answer is you find a consolidation, you check if both sides of price rating it, if both sides of that perturbation align, then that's how you know that you have a proper initial condition. Simple as that. So I kind of just killed two birds with one stone there. So now, let's answer a third question. I've been asked this a lot. Actually, shoot, I should probably keep that. No, I don't need to keep those rated. Third question. How do I know which initial condition to use? I've been asked this a ton. A ton. Now, right here, we've already defined as an initial condition. Well, what's interesting is, in our prior video, we also determined this as an initial condition. And we also determined this as an initial condition. Although we determined this as an initial condition on lower time frames, so it's not going to respect as well on this time frame. But we did determine this as an initial condition. So we have 3 initial conditions that we've determined. Now, where are some other places that we might be able to find one? Well, let's think about our rules. We find a consolidation and we align both sides. I found a consolidation right here. I see that price rated this side, and I also see that price rated this side right there. So now let's make the measurement. I'm gonna go like that. And it barely tapped that bottom one. I would consider this an initial condition, but I would be very hesitant to, because that's not usually what I like to see in a tap. So I would expect there to be a lot of deviation due to it barely hitting that. Here, bodies fit perfectly within. Here, price expands completely beyond. And then it uses it as support. There's deviation from this range. This pullback was supposed to happen in there. So as I expected deviation, and same thing, deviation from here to the 13. So there's that one that you could maybe identify. Hold on, there you go. Then we have this one, which we've already identified. And then we have this one, which we've also already identified. Oh wait, shoot, I should probably like that. And then we have this one that we've also identified. Now this probably looks like a lot of lines on your screen all over the place, but I want to show you something. So I will fill in each of our target areas. Just like this. Take these, fill them in. This might take just a second, so you can fast forward if you want. But this is all for a reason. Those. Then these. I'm doing all this live, so sorry if you guys are annoyed, but I'm trying not to provide any fake commentary or pre-planned anything, right? Like, all this is straight from my own head, right? Like, I haven't planned any of this. I'm literally just going off of how I could answer it, like, legitimately, right? So I'm just trying to give you guys the best explanation possible. So sorry, but I'm gonna do that, and then this one. Well, I don't even need that one. This does my point well. Okay, so we're looking at all these. Each initial condition itself can be considered a range. You see that even with this, a new initial condition being created, it still respected this one. It still respected the liquidity rate, and it still respected that target. Up here, you could see that it used prior trajectories as support. Same thing here. You see that it bounced off of the prior trajectory there, just like it would with an order block. Right here, initial condition, you could see that price went directly to it, filled it perfectly. So what I wanted to show you with this was, even when multiple trajectories occur, all of them are still accurate to an extent. The further away you are, the harder it's going to be to use. Could it still be accurate? Yes. If you wanted to use this one, if you wanted to use this one, if you wanted to use this one or this one, you could technically use any of them. Just keep in mind, the most recent one will always be the most accurate. If you see that this one just happened, this one will always be the most accurate. If you see that this one just happened, if price is currently like this, then this one would be the most recent one, in which case this one would be the most accurate, right? This one you could still use, but which one are you expecting to be accurate? You're expecting this one to be more accurate than this one. Does that make sense? So, when you are asking the question of which one do I use, all of them are valid. Whenever they occur, they are valid, period. They are new trajectories that are forming. They are new waves that are occurring due to an input of liquidity at different moments. What happens when you combine multiple... If I'm sitting at that flat body of water, and now I have a handful of rocks, and I throw all of them in this flat body of water at once. I don't just have one boulder, I have a bunch of different rocks. I am now creating a dozen different ripple effects that are all intersecting with each other. On the surface, it looks like some super messy water, right? It just looks very wavy. It looks like the wind's getting in lots of waves and stuff like that. But what you don't know is that there's hidden order beneath that, and each wave is due to its own set of ripples due to some event, right? It's exactly what we see with price. You have a ripple effect, ripple effect, ripple effect, ripple effect. They're all intersecting with each other, and you can't really see that there's a ripple effect, but there actually is. So you could use all of them, is my point. You could use this one, this one, this one, this one. You could use them all. Now I have to delete all this. Hold on. I'm just going to go to my object tree. Go to all this. Delete. So those are the 3 questions that I get asked the most. How do you know if your initial condition is correct? How do you find the initial condition? And what do you do when there are multiple initial conditions? Which one do you use? Which one do you prioritize? So we're about an hour and 11 minutes in. I'm going to try and do this top-down analysis rather quickly, but I'm going to be doing it in terms of SMC analysis. Now, I said it before that you can do all of this. You really only need one ticker, or one time frame, sorry. You only need one time frame to use on for your projections. You don't need to fill 3 different time frames or a bunch of different time frames with different projections. You just need one. And this is exactly how you do it. All right. I'm going to be explaining this in terms of SMC analysis, because again, this is what it works best with. Market maker models, power of 3. If you don't know this, if you've never experienced this or heard of it or anything like that, I don't use indicators or anything like that. I just look at price. Please watch ICT. Go to him. Go to my Twitter. There's lots of people on there. But ICT is the one person that I'll recommend you go to. He will be in the description. So, right here, I see that we are currently pulling on the monthly on NASDAQ. We pulled back. We are currently in this range right here. This is the range that we are within. All right there, right? When we take our dealing range, this is the 50% principal, our 50% mark, and we highlight the bodies. We hit just beneath 50%. We rated there. We rated there. Whenever you get rate high, rate low, or rate low, rate high, whenever you get external to external, usually you could expect some type of change in direction. And we also took out this fair value gap right below that liquidity right there. So we rated that low, and took out that fair value gap. And then we also got the external to external, which could signal a change in direction. And we're below our 50%. So all of that is good signals for higher prices, which of course we did. We went up to here. We rated there. So we have a raid here and a raid here. We now have a new dealing range. I'm going to delete that dealing range. I'm going to pick up this one. I'm going to draw it from here to there. And this is our new dealing range right here. Now, we got above this prior order block. Chances are it could be a first line of defense and we could just bounce right off and continue higher. I don't want to see that. I would like a retracement down below to our 50%. That's where I feel most comfortable. That's where I feel that prices are cheapest, are below their equilibrium point. If price were to reverse right here and it were to continue, I just wouldn't enter. Maybe I would play it on lower time frames, but this wouldn't be a monthly play for me. So what I'm looking for is it to go below this 50% level. Now, is there a point of interest below here that I could look at? Well, there's this giant order block right here. But that's very big. However, I think that would probably be my higher time frame monthly analysis. If you want, you could use the Feigenbaum projections here. I would not do it on the monthly. It tapped right there. It tapped right there. So where is our initial condition? Well, initial condition happens to be exactly where that order block is. So I just wouldn't use projections on the on monthly time frame. I only want to use them on one time frame, just one. So what is my current monthly bias? Well, my monthly bias is that price is currently going down to right here. That's my monthly bias. What will happen right here? It could do this and keep going lower, or it could do something like this and then make new highs. We will start assuming what happens next when we get to that point. But right now, my immediate idea is we're going lower to here. So I'm now going to take all of that, I'm going to folder it, and I'm going to label it. I'm going to go to visibility, 1 month, and I'm only going to make it visible on the daily. I'm going to skip a time frame. I'm going to go from the monthly to the daily. I'm going to go down to here. So, what was my bias? What was my bias? My bias was that we are going lower to here. That's my bias. I want right there. So I'm now looking at the daily. What I'm going to do, I'm going to look for power of 3, and I'm going to look for a market maker model down to here. So, initial condition. I'm going to do now something a little bit harder to do. And this is why ICT pairs best with Feigenbaum projections, because you can't do this with moving averages, you can't do this with MACD. Since I'm already expecting higher prices, even though I have not seen this pattern yet, what I do see is that we hit one side. We have not hit the other side yet. However, my higher time frame bias is already to the downside, which means with my higher time frame bias paired with just one side hitting, I am more than confident to say that this is a correct initial condition. That this initial condition is correct. I'm more than confident to say that. So, we can see that our target, our second target, aligns with our higher time frame target. I am expecting price to be somewhere in this range. Now, it could deviate. We could see something like this. We could see this, a consolidation, it dipped lower, and then a new trajectory forms to the upside. We could see that happen, for all we know. But right now, all I know is that my higher time frame target is this gray box, or brown box. And my current projection aligns with my higher time frame target. So now what am I going to do? Now what am I going to do? Well, if every day, so if my bias is bearish towards this area right here, right there, then every day, here, what I'm going to do is I'm going to folder these one more time. Change the visibility settings. Now, my daily drawings, I'm only going to make it visible on the 1 hour chart. 1 hour. Only on the 1 hour. This is my main target right here. This is my first target. And I have a script turned on right now that paints the higher open, high, low, close. It's called short-term OHLC. This is a private script, so I've already tried posting this on TradingView. They have removed it and almost banned my account when I kept trying to repost it. So I'm sorry, I cannot give it to you guys. But there are other scripts out there that do this exact same thing. I've used them. I'm just trying to learn coding, so I made my own. But what I have here is basically the daily candles projected on the 1 hour chart. So if I were to hide the candles, here, what I'll do is all right, that should be easier for you guys to see. But what I have here is I have the open, or I mean the high to low. That's what the brown box is. It is the high to low. That blue line is the open. Now with power of 3, you want manipulation above the open, and then distribution lower. So the open would be right there. That is what you want for a bearish power of 3. So when I bring back my candles, what is my bias? My daily bias is bearish down to here. So every single day, I am looking to enter above the open to go lower. Every single one of these would be high probability entries. Every single one of those. Each of those are high probability entries. Does that make sense? These are all very high probability entries right here. Because our bias is very bearish, and we're looking for power of 3. We're looking to enter above the open and take price to the downside. We're trying to take advantage of the monthly expansion, or the daily expansion in this case. In which case, right here was your daily market structure shift. You technically could have made this your main entry. All the way back there. And taking it all the way down. If you were going to be swinging this and holding it for days and days and days, you know, that's how you do it right there. So that would be the top-down analysis process. The reason I'm showing you this on the higher time frame charts is because I want you guys to be able to go through your charts and match up your charts with my charts. And if I'm doing this on the 1 minute time frame, you can't do that if you're watching this 6 months from now. So I'm doing this on higher time frames so that way everybody has the chance to actually match up their charts with my charts and, you know, things like that. Maybe on the hourly right now is going to be a little bit difficult for that, but you should be able to do that with the daily and monthly easily. So that's a top-down analysis process for NQ. So now, I'm going to just delete all this, make it a clean chart. Now let's go to ES. Now ES and NQ are correlated. They should be very close to the same. So you should already have, if you just did your analysis on NQ, but you haven't done on ES yet, you should already have an idea of what your analysis on ES is going to look like. So again, we're going to do the exact same thing. I'm going to do this a little bit quicker so that way you guys could see how quick it could actually be, right? I know me explaining it is a little bit time consuming, but when you're actually doing it, it's definitely not bad. So I see we reached below there, and I see that we took liquidity there, and then I see that we took liquidity there. So I'm going to make this my new dealing range right there. I'm going to delete that one. And now I'm going to look for lower prices down there. I'll say that's the order block that I'm searching for. So what's my bias? Well, my bias is we just took liquidity. We just got filled by that order block. And now I want lower prices below the dealing range towards that order block. Put all that. 1M. Visibility. 1 and 1. Remove the hour. And done. Analysis on one time frame done in 60 seconds. 60 seconds. So if you're going to say that this is, it's too time consuming, it's too hard, I just did it in 60 seconds. All right. What's my target? My target's down there. So what am I expecting? I'm expecting an initial condition to now form on the daily, in which case now there are two things that you could do here. You can make that your initial condition, or you can make that your initial condition. What do you think I'm going to say? What do you think I'm going to say? I think both are correct. This one, we have targets that align with our higher time frame bias. It hits there. Will it hit there? That'll be the deciding factor. That'll be the deciding factor right there. This one, we also have targets that are aligning with our higher time frame bias. As long as it aligns with our higher time frame bias, and as long as the conditions are met, that it's respecting our ranges, I will consider that a true initial condition. For this purpose, I will use this range right here, right? This whole thing right here. So I'm expecting this side to get rated, which we did right there. And I'm expecting us to get down into this area. This would be our end target. So again, I'll do that one day. There we go. Go to the 1 hour. And what am I doing? I'm looking for power of 3 entries all the way down from here to there. From one target to the next. From there to there. Every single power of 3 is another entry lower. Simple as that. Will you get some losses? Sure. Look what happened right here. Right here, you probably would have suspected this. You probably would have sold right there, only for it to go higher. How many times did it do that? It did it for one single candle before going lower another four fucking candles. So bite the bullet with those small little L's in between, but 90% of those candles are perfect power of 3 entries to the downside. And you need to take every win that you can and just bite the bullet on the losses that you have. Cut them short. Don't let them run. The moment you see price run back above that open, just pull out. Don't let it sit there. You know that over the next X amount of days, you have a ton of opportunities for more entries. So if you get something that just goes the opposite way of you for 1 or 2 candles, let it happen. It's fine. You have so many more opportunities. Cut your losers short. Easy as that. This top-down analysis process is not difficult. It's going to be a little tricky to get the hang of. It's not difficult, though. It is simple, it is quick, it is logical, it is mechanical, and it's very precise. Very precise. It gives you very precise ideas of where price is going next. Now let's go to DXY. Now DXY is interesting. This is an interesting case right here. So, one might say, if I were to go to like the fucking 3-month chart, that looks like it could potentially be its own thing forming. But again, we didn't get that side. So can I say that? No. So I'm not going to consider that. But I just want to point that out because I see a giant consolidation and I see that. So I'm going to put a pin in that thought. And I'm going to say there is a chance that price will not go back above this high. A chance. Do I know if that's the case or not? No. But do I know that the possibility exists? Yes. In some universe, it exists where price does not go above that high. So, considering that, we have our range right here, right? This is our range that price is currently in. We hit the dealing range. Hit just below 50%, exactly what we want to see. Then what happened? hit our point of interest. Exactly as we wanted to see. Okay. Immediately, right now, what I can say is I would like to see higher prices. I would like to see price reach in to this fair value gap right here. At minimum. At minimum. Now, what did I just say? I said that there exists a possibility that price continues above this high. There exists a possibility where price goes like this and then just continues above, right? I am not betting on that possibility, though. What I am betting on, though, is that price at least does this. Does that make sense? So my initial target is this fair value gap right here. That is what I think price is going to next. Where I think price is going to next. So I'm going to take that. Again, I'm going to group it. Keep your charts clean, please. For the love of God. For the love of yourself and your dignity. Keep your charts clean, people. Holy shit, I get tagged in the craziest photos, I swear to God. Okay. My bias, we're going up that way, okay? Considering that, what am I going to do right now? If I can find one, I would like a completed model. Or a completed, remember the thing I gave you? Consolidation, raid, distribution. This side hits, this side hits. I would like a completed formation of this. Unlike the futures, though. The futures one, we don't see a completed one because we're in the middle, or we're just ending the trend. It seems like this one is a little bit further on. So I'm going to start at where price currently is. Price is right here. I'm going to look over. I'm going to consider what I have before I start anticipating. So I am not going to consider that this is a projection. Even though it kind of aligns, I'm not going to consider it. Not yet. I'm going to keep going. I see another consolidation right here. What do we get when I measure this? I see that price went a little bit past it. That's not what I like to see. I don't like to see that in a measurement. And price still hasn't taken the other side yet. So I can't even say for certain that that is a measurement. So I'm not going to use that. No. I'm going to keep going. I see another consolidation right here. I mean, price hits that one. But does it go? Sure, it goes to that one. But we didn't get our power of 3. We didn't get what we were looking for. I'm not going to consider that as a trajectory. I'm going to keep going. Now this is interesting. I see a low here. I see a high here. Here we go. Now, when I pull this over, what do I see? I see price hit this side. I see price hit this side. This is what I like to see in a confirmed trajectory. This would be the trajectory that I use. So to give you guys a better view of it, here's the initial condition. That would be the trajectory that I use right there. So now, we now need to see this align with our higher time frame bias. Does it align with our target above? Yes. Our second target aligns with our target above. This is what we like to see. So, where am I targeting? On the daily. I'm going to be targeting right there. So I'm going to take all of these, put them in the folder one day. And I'm going to bring it down to the hourly once more. That way only the hourly could see those. Oh. I don't even have the script on this one, so hold on a second. Oh man. Shit. Ah. Not that much. Okay. That'll be fun. Okay. So what am I doing? It hit that side. It hit that side. I'm now looking for bullish power of 3 entries up to here for my first target, and then from there to there for my second target. So every movement, every time price gets below the open is a buying opportunity. You see right here, it kind of didn't for only how many times did it fail? Out of all of these right here, it failed for this candle and it failed for this candle. Two times. Every other candle was a success. So this is the model. You know with very high probability that price is going from there to there. So use power of 3 on lower time frames and take advantage of that, and use every movement below the open as a buying opportunity until you reach your main target on the monthly, which gives you a shit ton of entries for a very long time. Does that make sense? So that was top-down analysis on 3 different tickers. And we did all 3 of them within 30 minutes, which means that it was less than 10 minutes per ticker. And that was with me explaining it. I could have gotten it done in about 2 minutes per ticker. So if anybody wants to say that this is too complex or too difficult, think again. I could get this done very quickly. And you can too if you practice. Now, hopefully this has answered a bunch of your questions. I guarantee you people will still have questions. So I'm just going to put this one out and I'm going to let people ask or watch it and then ask away afterwards. But please keep backtesting. Send me data. Send me your examples. If you're going to tag me in anything, keep your fucking charts clean, for God's sake. Keep them clean. I don't want to see moving averages, VWAPs, MACDs, and 10 different triangles and all this shit. I only want to see what's happening with the Feigenbaum projections and any SMC analysis that you have. I don't want to see all this other shit. So if you're going to tag me in any examples, keep your goddamn charts clean, for the love of God. And yeah, I think I'm just going to end this video off right there. Thank you all for watching. And please, any other questions, tag me on Twitter, comment below, share this with your friends, with your family. It's all free. Don't believe me? Test it. I don't want you to believe me. If you watch this video and you immediately go trade it, shame on you. How dare you? Watch this video, test it, and try to prove me wrong. Try to prove that what I am explaining to you does not happen. It's going to be more difficult than it is to prove that it does. I promise you. Till next time.